Hello friends, welcome to our channel. In today's video, we are going to look at the mindset of market participants and provide an outlook of themes to invest in the market. We all know that the stock market never goes up or down in a straight line. Stock markets are bound to move up eventually at some point in time, testing the patience of investors, traders, and speculators. If you check for opinions on the stock market, you're most likely to hear that stock markets are risky and that people lose more money than they make. Let's go through the reasons for people not making it big in the stock market. There are basically five reasons. Firstly, we always try to seek help from outsiders regarding free tips on stocks or the index, but we never manage to make money out of it. Secondly, never average down stocks. That is, if a stock is falling, never to average it unless it is a blue chip and there is nothing fundamentally wrong with the business. Thirdly, people who venture out in the stock market think that making money is very easy and they can become rich easily. However, that is not true. Even successful investors like Rakesh Jhunjhunwala, Vijay Kedia, Ramakrishnan Damani, Ashish Kacholia have waited long enough to be successful. Lack of knowledge is also crucial in making sound decisions. We have to plan our trades and wait patiently for the opportunities. Sometimes taking no trades amounts to longer stay in the market. Lastly, planning your finances plays an important role in the stock market. You have to segregate your expenses and only apportion funds that you would not require for the next 3 to 5 years. You might have been reading and hearing that in the stock markets, in order to make money, one has to buy the dip. However, the question that would arise in the minds of all is that can you really time the market? Or can you buy at the bottom? The simple answer is no. Moreover, are we sure that the stock that we pick will move up and not fall further? Ignorantly, what most of us do is to buy stocks which are at historic close or 52-week close, thinking that buying at the lowest might give us fabulous returns. However, 9 out of 10 times we fail to do so, and these stocks underperform the rest of this index. This is true for both investors and traders. The list of historic lows or 52-week lows can help you shortlist stocks which can be further analyzed. However, it should not be a deciding factor for buying stocks. Contrarily, if you can hope to get better returns when stocks trade at their 52-week highs or historic highs. But this strategy also is not foolproof. The ideal strategy to discover multibaggers is to track consistent performers and keep faith in your conviction. There may be several factors why stocks do not perform or underperform the market. Firstly, it will depend on whether the cash flow of the business is clear or not, whether the financial statements make sense and are accurate, whether there is strategic long term planning for the business. Secondly, it also depends on how debt is managed. Debt can be a very useful tool when starting a business and fueling growth at different stages of its development. But sometimes financial events outside of your control can take you further into the red than you actually planned. One of the strongest pillars of a firm is having a good management system. The effects of poor management in an organization only leads to a downfall of the firm's reputation and on the whole bad for the business. Cost management can be generally considered as a set of techniques and methods for controlling and improving a company's activities and processes, its products and services to achieve cost effectiveness. So, if there is no cost control, then the goals of the business cannot be achieved. Some businesses thrive when they need to change or adapt. Innovators grab the bull by the horns and steer the market into the next iPhone or Google. But some don't realize that in order to be successful, you need to embrace change. Examples could be Enron and Kodak, who were pioneers in their respective businesses, but they failed to make it big in the business. Sector rotation happens in all of the stock markets of the world. So, if the stock is in a particular sector undergoing downtrend, then the stock will also underperform. One should never average stocks which are falling continuously. There is no reason to believe that you will always profit from your investments when you average it out when the stock falls. Hence, you must first believe in your instincts whether it is wise to keep it for the long term or not. If your answer is yes, then keep it in your portfolio. Otherwise, it would be prudent to book your losses and invest in businesses which would have better potential to outperform. By this approach, your recovery in the stock markets will also be faster. Your mindset should not be that if you have suffered losses against a particular stock or set of stocks, you would have to recover it only from those stocks. If you continue to do that, your journey in the stock market will be short lived. So, averaging works out only for the long term investing. So, if you are long on the market and you are patiently waiting for around, say, 7 to 10 years, then you can average. If you have a contrarian view, yes, you can average it because you will have a lot of time and a lot of analysis which can be done during that period. Averaging involves subsequent additional investment since your idea is to bring down the cost naturally. This strategy will work only in cases of blue chips since the fundamentals would be stronger and in the event of markets going up, these stocks are the first ones which would give you returns and it would also be a good it could build your portfolio. We should not buy stocks that can get affected by macro factors like dollar appreciation or depreciation, commodity fluctuations, physical and monetary measures, etc. In this scenario, it is prudent to focus on conditions pertaining to the Indian markets, which has opportunities galore. According to the current situation, buying should be focused on India centric themes and products. The biggest truth about our economy is that it will grow as we progress, since the disposable income of an average Indian has been constantly increasing. People are buying products which they would not even think of in the early 70s, 80s, and 90s. There are new businesses emerging, replacing the old businesses. There are a lot of startups now, and even more participants in the market than ever before. So, our primary focus should be on the businesses in the following sectors, namely consumer discretionary products, healthcare, and retail. It is prudent to invest in the habits that we all practice as well as drive the Atmanirbhar policy since we are becoming more aspirational than ever before. Investing should be simple, where we do not feel tensions about government policies, international news, etc., and believe in our instincts about the products that we see and use. Finally, let's recap the summary of this video. Firstly, be patient and wait for opportunities. Never buy stocks in FOMO, that is, fear of missing out. Do not buy sectors, themes, or stocks which you do not understand. Fourthly, never average down stocks unless it is a blue chip and the fundamentals of the business is strong. Finally, stay invested for long. Be Indian, buy Indian. Thanks for watching and have a nice day.